This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I'm very excited to announce today that in most formats, my newest book, Trend Following, my 5th edition of Trend Following, and forget what you think you know, forget about any other edition. I'm very happy that you have supported me over the years on other editions. But this new book, this new Trend Following edition, it's a new book. It's gone from 100,000 words to 230,000 words. It is the definitive effort on trend following. Yeah, some other books have been written, lots of good details, but this is it. And I've had the time to know, because I've looked at everything else, that this is it. The hardcover, and it is a hardcover. My 2009 edition was paperback. I told Wiley on this particular edition, I want hardcover. If we're going to be at 688 pages, I want a beast. Now you can also go the Kindle version, and the audiobook will be here within a few weeks. The audiobook got a slight delay because my vocal talent guy, somehow or another, there was a flood in his studio. So a slight delay. But I hope most people go for the hardcover. I really built this edition as something you can put on the shelf next to the fountainhead and the Bible, or whatever religious book you have there. Or if you don't have a religious book there, then it's next to Atlas Shrugged. I'm not the biggest Kindle guy, but I'm a little disappointed with how they are forced to lay out the side margin quotes in this edition of Trend Following in the Kindle edition. I guess you really don't have much room with the way a particular digital book is structured. So the side margin quotes are embedded in italics inside the text. They're easily broken out and you see it, but it's not as cool as the hardcover physical edition. And for all of you audiobook fans out there, I get it. You're in the car. Listening is much easier than reading. It's just the way the world has gone for a significant part of the population. Well, I can promise you, you're going to be able to drive a long freaking time before this edition of Trend Following runs out. I have no earthly idea how long it's going to be exactly, but it's going to be up there, perhaps in dozens of hours. Today, to celebrate this release, I want to read a few passages from the new edition, my 5th edition of Trend Following. I'm going to read the preface, or at least a part of the preface, and a part of chapter 1. I think this will give you a flavor for how I'm pushing the envelope in this subject today in 2017. First, the preface. Want to take the financial journey to a new investing philosophy? One that might very well affect the rest of your money-making life? I cannot guarantee the yellow brick road, but I can promise the red pill will leave you wide awake. In late 2016, the Wall Street Journal reported that Steve Edmondson, the investment chief for the Nevada Public Employees Retirement System, has no coworkers, rarely takes meetings, and eats leftovers at his desk. His daily trading strategy? Do as little as possible, usually nothing. The Nevada system, $35 billion in stocks and bonds, are all in low-cost funds that mimic indexes. He may make one change to the portfolio a year. Look, that's not exactly a life-changing revelation, I know, but that do-nothing, sit-on-your-hands investing premise doesn't stop with one-man shows. Dimension Fund Advisors, LP, DFA, the 6th largest mutual fund manager, is drawing in nearly $2 billion in net assets per month at a time when investors are fleeing other firms. DFA is built on the bedrock belief that active management practiced by traditional stock pickers is futile, if not an absurdity. DFA's founders are pioneers of index funds. Now we are getting somewhere because just about everyone has money tied up in an index fund, which in 2017 is not exactly pioneering. But the much larger issue at hand, unknown to most, is that there is an academic theory that allows anyone to confidently index. The efficient market theory, EMT, states asset prices fully reflect all available information. This means it is impossible for average investors, or superstars for that matter, to beat the market consistently on a risk-adjusted basis, since market prices should only react to new information or changes in discount rates. EMT set in motion with Louis Bachelet's PhD thesis published in 1900 and developed by University of Chicago professor Eugene Fama, argues that stocks always trade at fair value, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. Let me drop the nuclear warhead, the crazy North Korea dictator nuclear warhead on that perspective. There is a mind-numbingly large hole in this cool-sounding theory. EMT, by definition, leaves the epic October 2008 stock market meltdown out of the academic equation. And for those who know about the sausage making of writing peer review papers or engineering a PhD, much of modern finance's foundation was bricked together with EMT mortar. Fama was ultimately awarded the 2013 Nobel Prize in Economic Sciences because his findings changed market practice. That is, the worldwide acceptance of index funds. Those findings are the generally accepted status quo. Not everyone, however, is a true believer guzzling the Kool-Aid. You can feel the trend-following counter-argument about to follow, eh? One of the first and loudest critics of EMT was famed mathematician Benoit Mandelbrot. He saw EMT proponents sweep big events like 2008 under the carpet, like kids cleaning the house for the first time, calling them acts of God. French physicist Jean-Philippe Bouchot, he sees EMT marketing in play. Quote, "The efficient market hypothesis is not only intellectually enticing, but also very reassuring for individual investors who can buy stock shares without risking being outsmarted by more savvy investors." End quote. Bouchot continues, quote, "Classical economics is built on very strong assumptions that quickly become axioms. The rationality of economic agents, the invisible hand, and market efficiency, etc. An economist once told me, to my bewilderment, these concepts are so strong that they supersede any empirical observation. As Robert Nelson argued in his book, Economics as Religion, the marketplace has been deified. In reality, markets are not efficient. Humans tend to be over-focused in the short term and blind in the long term, and errors get amplified through social pressure and herding, ultimately leading to collective irrationality, panic, and crashes. Free markets are wild markets." End quote. David Harding, a man you might not know yet, ratchets up the polemic by describing EMT in apocalyptic terms. Quote, "Imagine if the economy as we know it was built on a myth. Imagine if that myth was the foundation stone on which the mainstream financial systems that control the global economy have been erected. The great bazaars of stock markets, bond markets, fiendishly complex financial instruments, credit default swaps, futures and options on which the fortunes of billions rest. Imagine if the myth was the key cause of the global crash in 2008, and if its perpetuation today threatened another catastrophic crash in the future. We don't have to imagine. The myth is efficient market theory." End quote. Harding does not have a Nobel Prize, but he does have a net worth of $1.4 billion. He is a flat-out financial heretic and would not be offended if you called him a punk rocker for his anti-establishment attitude. In prior centuries, he absolutely would have been burned at the stake for his wholesale dressing down of the financial high priest. He knows that to question EMT is seen as madness by academics, banks, pension funds, and endowments. Interestingly, and with a bipolar flair, the Nobel Committee split the 2013 Nobel Prize among economists with radically different theories. Robert Shiller, a man focused more on behavior and who shares the Nobel Prize with Fama, sees the contradictions. Quote, I think that maybe he has a cognitive dissonance. His research shows that markets are not efficient. So what do you do if you're living in the University of Chicago? It's like being a Catholic priest and then discovering that God doesn't exist or something you can't deal with, so you've got to somehow rationalize it, end quote. Harding goes further, explaining EMT madness in an everyman way. Quote, the theory of rational markets treats economics like a physical science, like Newtonian physics, when in fact it is a human or social science. Human beings are prone to unpredictable behavior, to overreaction or slumbering inaction, to mania and panic. The markets that reflect this behavior do not assume some suprahuman wisdom. They can and sometimes do reflect that volatility. Further translation, human nature isn't rational. It blows bubbles and then pops bubbles. And you can see this going back hundreds of years. The Dutch tulip mania, the South Sea bubble, the Mississippi bubble in the 1700s, the British railway mania bubble in the 1800s, the Panic of 1857, the 1973 to 74 stock market crash, Black Monday, 1987, the Japanese bubble and economic crash, 1989 to current, the dot-com bubble, 1999 to 2002, the U.S. bear market, 2007 to 2009, the flash crash, 2010, Chinese stock market crash, 2015 to 2016, Brexit, 2016, and on and on and on. It never ends. But it's beyond being not rational. Those events, the human actions driving those booms and busts, are best described by academia as prospect theory, cognitive dissonance, the bandwagon effect, loss aversion, and assorted heuristics in judgment and decision-making, to name a few of the hundreds of biases inherent in people's lizard brains. No doubt, the efficient versus not efficient debate will not be resolved in these pages. Perhaps it will never be satisfactorily resolved in an academic mind is bigger than yours sense, which would not be surprising given that human beings and their egos, greed, fear, and money are knotted up so tight as to restrict brain blood flow. And please don't expect this work to be filled with the latest and greatest macroeconomic bubblegum predictions. You already know that is bullshit, completely unrelated to making money, even if you've not yet admitted that fact to yourself. In the face of such chaos, complexity, and human frailty, my curiosity is quite simple. Answer a question. Quote, why does David Harding think he is right? And more importantly, how in the hell did he get all that money trading the likes of Apple, Tesla, gold, US dollars, crude oil, NASDAQ, natural gas, lean hogs, palm oil, wheat, and coffee without investing in an index or having a fundamental expertise in any of those markets or the ability to predict directions? End quote. That is a worthy question. And the answer is a follow the big money adventure. That is part of the preface of this new edition of Trend Following. And that worthy question is why I've put together 688 pages, 230,000 words. Oh, sure, to execute trend following strategies are not terribly difficult, complicated. You can figure it out pretty quickly. You can write your rules out. But the how, the why, the philosophy, the psychology, the decision-making, everything that goes into it from a 360-degree perspective, that's what motivated this 5th edition. Next, I'm going to read the beginning of chapter 1 of this new edition of Trend Following. Now, I really took a red pen to chapter 1, not because the original versions were bad. I'm older. I'm more experienced. I wanted more depth. I wanted more grist to chew on. Philosophically, I want the foundation of trend following to be secure. And that starts with speculation. Let me jump into the first chapter. It might sound pedantic, or perhaps that I'm focusing on the extraneous. I'm not. A speculator's ability to receive a price they can count on as fact is the foundation of markets. Said another way, with no price, humanity is back to cavemen beating each other with clubs. Austrian economist Ludwig von Mises puts price discovery's value in perspective. It is the very essence of prices that they are the offshoot of the actions of individuals and groups of individuals acting on their own behalf. The concept of exchange ratios and prices precludes anything that is the effect of actions of a central authority, of people resorting to violence and threats in the name of society or the state, or of an armed pressure group. And declaring that it is not the business of government to determine prices, we do not step beyond the borders of logical thinking. A government can no more determine prices than a goose can lay hen's eggs. What a great line from Mises. And if you've not read his book, his classic, Human Action, please do. Back to the story. Although government can't determine prices in the long run, in the short term, government will attempt to directly rig the market system via QE, ZERP, NERP, or whatever acronym sure to follow. However, speculation is all there is for making choices about those market prices. Learning how best to speculate using prices is not only a worthy endeavor, it is a survival of the fittest concept that traces back to the earliest literature of Wall Street. This is kind of a side note for a second, but I really dug deep to go back and find some of this early literature. Because some of the writings from the 1700s and 1800s, bloody brilliant. You read the stuff today across all the major mainstream rags, cannot compare to some of the sources that I've located. From Young America on Wall Street, 1857, quoting a French poem about a latter-day millionaire. Monday, I started my land operations. Tuesday, I owed millions by all calculations. Wednesday, my brownstone palace began. Thursday, I drove out a spanking new span. Friday, I gave a magnificent ball. Saturday, smashed with just nothing at all. But you know what? There's nothing wrong with that turn of events. It's normal. It's the expected up and down. Luck is always in play, but so is skill. Let me quote from the Theory of Stock Exchange Theory, 1874. A man who wins by haphazard speculation, who chances to operate successfully until he has filled his pockets and retires with his gains from so fascinating an arena, is 1 in 100. Anyone who knows anything of stock exchange speculation will confirm the statement that to the ordinary run of men, the game is not worth the candle. There are, however, conditions under which speculation in a market where 10 or 50,000 pounds can be lost in a half hour may, under given conditions, be systematically practiced profitably. First, and most important, perhaps of all those conditions, is the temperament of the speculator. Let me interject here for all of you out there that are yelling that you just want a trend-following formula, and that's all you want to hear about. The individual that is yelling and screaming that all they want is a trend-following formula without even understanding the philosophical underpinnings, that idiot is off looking to day trading, FX trading, and who knows what other inane chase the dog around the house scheme comes next. Back to the excerpt, 1874. Such a man must have a concrete hardness of indifference through which nothing can penetrate to his heart. It is as necessary to the success of his operations that he poses no more regard for the feelings or pockets of other people than a hungry tiger would for him if he were airing himself unconcernedly in a Bengal jungle. He has a purpose in view, just as a surgeon has when the amputation of a leg has been decided upon. The speculator's sole aim in the operation is the profit, towards which he cuts his way, regardless of the nature of the obstacles to overcome, just as the knife is plunged into the flesh, severing the arteries, the muscles, and sinews that surround the bone, which it is the object to reach and saw through. For a man to tread a path in which he must systematically not only disregard the interest of other people, but deliberately calculate upon the weakness of human nature which characterize the crowd in order to work upon them for his own ends, it is obvious that he must be constituted in quite an exceptional manner and not in a way that it is all desirable that others should attempt to imitate. If uninitiated people who enter the arena in which some of the professional speculators flourish were to spend some months in gathering information and in close observance of the modus operandi, so far as they can get to see and hear, many of them would soon be persuaded that they were utterly useless at such work and would retire thanking their stars. The haphazard man who is the antithesis of the professional speculator will generally be found as differently constituted as are the results of his operations. The man who makes a study and business of speculating, investigating every detail that it seems necessary to probe until he has adapted it to the rest of his machinery, will be found to be a hard-grained man, sailing very close to the wind, while your persistently haphazard man is mostly a person of flabby character and no less flabby mind, as easily frightened off a line that he has set himself to follow, and the innocence of a heart that expands with a delusive consciousness of possessing power as a stray rabbit. Such a class of man is to be found by hundreds in the haunts of stock markets, and they are always fidgeting in and out, first as little bulls and then as little bears, disappearing after a sharp panic like flies from a joint of meat that is so rudely disturbed by the shop boy, with the important difference that whereas the fly always gets something, the weak speculators invariably drop their money. Now that is just the very, very beginning of chapter 1. I'm laying the predicate for what comes before you can even get to the trend following technique. And it's speculation. Speculation is not a 4-letter word, last I checked. Now, plenty of you out there might think of speculation as something bad. I recommend a visit to the doctor. Perhaps that doctor can cure you of your problem, because you've got a problem. If you think speculation is a bad thing, it's not. It's mandatory. It's a must-have. You can't go without it. But as I introduce this new edition today, I wanted to give you a flavor of some of the extra gusto that I've added to this book. Because you can't get to the damn rules. And there are plenty of examples of that in the book. But you can't even get to the damn rules. You can't even get to the damn, hey, what do I do to try and make money if your mind is messed up? And what do I mean by if your mind is messed up? If your concept of money is messed up. If you think you're going to make money every day. If you think you're going to day trade and make money every day, you're already lost. Give it up, man. It's over. Game over. You think you're going to make money every day. You think you're going to day trade every day. Delete this book off your Kindle. If you bought the hardcover, throw it in the fireplace. I will do nothing except upset you, piss you off, tick you off. Because I'm going to hold that mirror up in front of you, and you're not going to like the picture you see. Don't get me wrong, plenty of people will enjoy the picture they see because they will like the truth. But the vast majority of market participants don't want the truth. They want fantasy. They want a dream state. They want the matrix. The vast majority of market players, I truly believe, would like to be in a coffin with a feeding tube jammed up their anus. I don't know how feeding tubes work that way, but that's kind of what I imagine in the matrix version of investing. Mindless investors in coffins with feeding tubes rammed up there, you-know-whats. Sweet nothings pulsating through their body, telling them they will make money every day. Or in the alternative, buy the index because that always works. Just buy the index, stop thinking, and guess what? You're just like Warren Buffett. Actually, no, you're not. You're nowhere close. This newest edition of Trend Following is not only a polemic with strong opinion. It is a very detailed account that for the endnotes alone, the price of admission was cheap. The further study that this book will push you off onto worth the price of admission. But today, I just wanted to give a feeling for some of the new content, some of the perspective. Because let's be real, when stocks are so close to all-time highs, when there's been such a fantastic run, there's probably not any better timing for either those new to trend following or those experienced to trend following to sit down, take an inventory, dig into this newest edition, find some inspiration, develop your plan, and set it in motion. The best time to act is always when the waters are somewhat calm. Because when the shit hits the fan, when the proverbial shit hits the fan, it's too late. So I'm very, very pleased to throw this newest edition of Trend Following out into the calm waters. And if you do like this newest edition, and I hope like hell you will see the work that I've put into it, please feel free to go on to Amazon and say something kind. Don't rip the hell out of me. I know there'll be some crazy people that will think for $25 and 8 months of my work that somehow or another they've been scammed. But for those of you still attached to reality, and I know plenty of you are, I would be forever grateful to see your positive feedback. Thank you and enjoy. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, Trend Following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.